$81 billion. That is how much of Warren Buffett's fortune arrived after his 65th birthday. Buffett is worth around $150 billion today, but 99% of that money came after he turned 50. Read that sentence again slowly. The greatest investor alive built almost nothing, relatively speaking, in his first 50 years. Then the snowball took over and never stopped. Most people think Buffett is rich because he picks magic stocks. He is not. He followed 3 boring rules that anyone can copy. No secret hedge fund, no insider phone calls, no complicated math on a giant screen. 3 plain rules a teenager could memorize in 1 minute. And yet almost nobody actually follows them. Not because the rules are hard to understand, because they are hard to sit still for. Today we break down the hidden math behind those 3 rules. We will follow 3 ordinary investors, each earning about $60,000 a year. One of them ends up with $2 million. One ends up with barely $200,000. The only real difference is which rules they kept. Run the numbers with me. Here is what nobody tells you about getting rich. It is not about the return you earn in any single year. Buffett's average return is roughly 20% a year. That is excellent, but it is not sorcery. Plenty of traders beat 20% in one good year. They simply cannot do it for 60 years in a row. Between 1965 and 2024, Berkshire Hathaway compounded at 19.9% every year. The S&P 500 returned 10.4% over that same stretch, roughly double the yearly rate. That does not sound life-changing at first. But stretched across 60 years, double the rate becomes a different universe entirely. Berkshire's stock climbed about 5 million%. The broad market rose 39,000%. Same 6 decades on the calendar, wildly different endings for the money. Most people spend their lives chasing the 20%. Buffett quietly chased the 60 years. That single reframe is why he stands on a mountain while equally smart people stand in a hole. So the real question is not how do I earn Buffett's returns? The question is how do I avoid the mistakes that stop compounding cold? Because compounding is fragile, and one bad decision can reset the whole machine. Here is what the data shows. Meet Carla. Carla is 32 years old and works in hospital billing. She earns $59,000 a year in Ohio. She is not a genius, and she does not read balance sheets for fun. Meet Diana. Diana is 34, a teacher, and earns $61,000 a year. She is sharp, ambitious, and always hunting for the next big thing. Meet Maya. Maya is 28, a nurse, earning $58,000 a year. 3 women, nearly identical incomes, all starting to invest in the same year. On paper, they are the same person. Diana actually earns the most and reads the most financial news. If you had to bet on one of them getting rich, you would probably bet on Diana. You would be wrong. 20 years later, Carla has just over $1 million. Maya has around $800,000. Diana, the smartest and the most active of the 3, has $210,000. Same salary, same starting line, same 2 decades. The gap is almost $1 million. What happened? Diana broke Buffett's rules one at a time, always for a good-sounding reason. Carla and Maya kept them, even when it felt boring. Let us keep this fair and walk through exactly what each of them did. Because the difference was never intelligence. The difference was 3 rules, and whether they had the patience to obey them. Here is what nobody tells you about Buffett's first rule. Rule number 1 is never lose money. Rule number 2 is never forget rule number 1. That is the whole thing, in his own words. People hear that and roll their eyes. Of course, nobody wants to lose money, they say, but that is not what Buffett means. He is not talking about a stock dipping 5% on a Tuesday. He is talking about the permanent loss, the kind you never recover from, the kind that erases years of progress in a single afternoon. Here is the math most people never see. If you lose 50% of your money, you do not need a 50% gain to get back to even. You need a 100% gain. A loss and a gain of the same size are not equal opponents. Losses hit harder and they hit deeper. Drop from $100 to $50, and a 50% gain only brings you to $75. You are still down. That asymmetry is the quiet killer of ordinary portfolios. This is exactly where Diana went wrong first. Diana put $30,000 into a hot crypto token a coworker swore was going to the moon. A slick salesman online promised her 10 times her money by Christmas. He showed her screenshots in a rising green chart. Diana felt smart and early and lucky. 6 months later, the token collapsed 90%. Her $30,000 became $3,000. To simply get back to even, she now needed a 900% gain. That is not investing. That is trying to climb out of a well with a broken ladder. Most people think risk means excitement. Buffett thinks risk means the chance of not getting your money back. Carla did the opposite thing entirely. Carla never chased the 10 times bet. She asked one question before every decision. What is the worst realistic outcome here? If the honest answer was I could lose most of this, she walked away. She kept a cash cushion of $10,000 so she was never forced to sell in a panic. When the market fell 30% in a scary year, Carla did not sell a single share. She had no emergency, no debt collector, no reason to touch it. Diana, meanwhile, had already sold at the bottom to cover a credit card bill. Same crash, opposite behavior. That is rule 1 in real life. Protecting your downside is not being timid. It is the thing that keeps you in the game long enough for rule 3 to work. Buffett says the margin of safety is the 3 most important words in investing. He means do not drive a 9,000-pound truck across a bridge rated for 10,000 pounds. Find the bridge rated for 15,000 pounds instead. Leave yourself room to be wrong, because you will be wrong sometimes, and the goal is to survive it. Now here is the second rule, and it is the one that quietly wrecks the most people. Only buy what you actually understand. Buffett calls it staying inside your circle of competence. The size of your circle does not matter very much. Knowing the edge of your circle matters enormously. In plain English, if you cannot explain how a company makes money, you are not investing. You are gambling with extra steps. Buffett has skipped some of the biggest winners in history for exactly this reason. He avoided most technology stocks for decades because he said he could not predict them. He missed some gains, and he did not care one bit. He would rather miss a winner he did not understand than blow up on a bet he could not evaluate. Diana ignored this rule completely. After crypto burned her, she jumped into a biotech stock she read about in a single headline. She could not tell you what the drug did or how the company earned $1. She just knew the chart was going up and a forum was excited. A financial advisor in a sharp suit told her it was the future of medicine. She bought at the very top. The trial failed, the stock dropped 70%, and Diana sold again in disgust. She had now lost money twice, in 2 industries she never understood. Maya took the boring road instead. Maya did not try to be clever at all. She bought a simple, low-cost index fund that owns 500 of America's biggest companies. She understood it in one clean sentence. If the American economy grows over 30 years, I grow with it. That was her entire thesis, and it was more than enough. She was not trying to beat the market. She just wanted to own the market and let it do the heavy lifting. Buffett himself has said that for most people, a low-cost index fund is the smartest single investment. He even instructed that 90% of the money he leaves his wife go into exactly that. Think about that for a second. The greatest stock picker of all time told his own family to just buy the index. Because he knows the game most people should play is not the same game he plays. Maya put $400 a month into that fund and barely looked at it. She understood what she owned, so she never panicked. When you understand what you own, a crash looks like a sale. When you do not understand it, a crash looks like a fire alarm. That is the whole difference in one line. Diana was always running from fire alarms she lit herself. Carla and Maya were calmly shopping the sales. Here is the third rule, and it is the one that actually built the fortune. Let time do the heavy lifting for you. Buffett's favorite holding period, in his own words, is forever. He says time is the friend of the wonderful company and the enemy of the mediocre one. Compounding is not a fast machine at all. It is a slow one that becomes unstoppable if you never unplug it. Let me show you the number that changed my entire view of money. Imagine you invest $400 a month and earn 10% a year, the market's long-run average. After 10 years, you have about $82,000. Not bad for barely trying. After 20 years, you have around $303,000. Now watch closely what happens next. After 30 years, you have about $905,000. After 40 years, you have roughly $2.5 million. Look at that jump very carefully. The money you make in the final 10 years is larger than everything from the first 30 combined. That is the part almost nobody has the patience to reach. The first decade feels like pushing a boulder uphill. The last decade feels like the boulder rolling downhill on its own. Most people quit somewhere during the uphill part. Diana quit constantly, over and over again. Every time the market dipped, she sold and waited to feel safe. Every time it soared, she bought back in at higher prices. She was busy, active, and always doing something. And doing something is exactly what cost her the most. Carla did almost nothing at all for 20 straight years. She set up an automatic transfer of $500 every payday and ignored it. She did not check the balance during the crashes. She did not brag about it during the booms either. She simply let the snowball roll and roll. Maya did the same with her index fund, $400 a month, no drama. The 2 women who did the least ended up with the most. The one who did the most ended up with the least. That is not a coincidence at all. That is the entire lesson of Buffett's life compressed into 3 people. Activity feels like progress in almost every part of life. But in investing, activity is usually a tax you pay on your own impatience. Every time Diana traded, she paid fees, she paid taxes, and she paid the biggest price of interrupting compounding. Buffett says only buy something you would be happy to hold if the market shut down for 10 years. If that idea makes you uncomfortable, you are probably speculating, not investing. Carla could hold through anything because she was never betting on next month. She was betting on the next 30 years instead. And the next 30 years almost always show up if you simply let them. Before we go any further, let us kill 3 myths that keep ordinary people poor. The first myth is that you need a lot of money to start. You do not need much at all. Carla started with just $50 a week and a cheap app. The second myth is that you must be brilliant and watch the market all day. You do not, and honestly, watching it all day usually hurts you. The third myth is that investing is basically the same as gambling. It is not the same at all if you follow these 3 rules. Gambling is betting on a coin flip you cannot control. Investing is owning a piece of the entire economy for decades. Over any single day, the market really is a coin flip. Over 30 years, it has risen in almost every stretch of history. Time slowly turns that coin flip into a near certainty. That is the part the casino can never offer you. The house always wins at a casino, every single time. In a diversified market held for decades, you become the house. So what does Buffett actually buy, in plain and simple terms? He buys simple, powerful companies that people cannot stop paying. Think of the soda everyone drinks and the insurance everyone needs. Think of the railroads that carry the country's goods every day. These are not exciting businesses on a Friday night at all. They are wonderful businesses on a 30-year timeline instead. Buffett looks for what he calls a moat around a business. A moat is a durable advantage that keeps the competitors out. A famous, trusted brand is one powerful kind of moat. A network that everybody already uses is another kind. Being the cheapest producer in the whole market is a moat too. Maya did not have to pick these winning companies one by one. Her simple index fund owns all of the best ones automatically. When you buy the whole market, you own every moat in America. The winners carry the losers, and the winners win truly big. You do not have to be right about which company wins. You only have to be right that America keeps on growing. That has been a very good bet for over 200 years. There is a fourth idea braided through all 3 rules, and Buffett says it in one famous line. Be fearful when others are greedy, and greedy when others are fearful. It sounds like a cheap bumper sticker at first. In real practice, it is brutally, almost impossibly hard to do. In 2008, the whole world was ending, or at least it felt that way. Banks were collapsing and the market fell almost 57% from top to bottom. Ordinary investors were selling everything they owned just to stop the pain. Buffett did the exact opposite of the panicking crowd. He poured billions of dollars into American companies while everyone else ran for the exits. He even wrote a public letter titled simply, "Buy American, I Am." Within just a few years, those brave bets paid off enormously. Carla was far too young to invest back in 2008, but she never forgot the lesson her aunt taught her about it. So when the market dropped 30% in her own scary year, Carla did not freeze. She calmly kept buying her usual $500 every single payday. She was quietly buying great companies at a 30% discount. Diana was doing the exact opposite thing across town. Diana saw the red numbers and sold everything just to feel safe. She locked in all her losses and then missed the entire recovery. The market came roaring back over the next 3 years. Carla's cheap shares more than doubled in value. Diana's frightened cash sat on the sidelines earning almost nothing. A crash is not the moment the whole game is lost. For the patient investor, a crash is the biggest sale of the decade. The scary part is that it never feels like a sale. It feels like the end of the world every single time. Now here is a cost almost nobody sees because it is invisible on any single day. It is the slow drag of fees and taxes on an active investor. Diana used a fancy advisor who charged 1% of her money every year. 1% sounds completely tiny and harmless at first. Over 30 years, that 1% can quietly eat a quarter of your final wealth. On a portfolio that should have grown to $1 million, that fee can cost you over $200,000. You never once write a check for it either. It just silently vanishes into somebody else's pocket. Maya's index fund charged about 0.03% instead. On the same money, her lifetime cost was a few $1,000s, not hundreds of thousands. Same market, same returns, wildly different fees. Then there are the taxes on all of that constant trading. Every time Diana sold a winner, she handed the government a slice of the gain. That is money that can no longer compound for her, ever again. It is gone from the snowball forever. Buffett almost never sells his very best companies, and that is not simple laziness. It is a deliberate tax strategy hiding in plain sight. When you do not sell, your gains keep compounding untaxed, year after year after year. The government quietly becomes a silent partner who funds your growth for free. Every unnecessary trade fires that partner and pays the tax bill early. Multiply that one mistake across 200 trades in 20 years. That is how Diana turned a winning market into a losing account. Let me tell you about two more people, because this next mistake is truly everywhere. Meet a millennial friend of Diana's, 30 years old, sharp and funny. He started investing at 22, which is a huge head start in life. But every couple of years, he cashed out to fund a vacation or a new car. He treated his investment account like a slightly slow checking account. By 40, he had almost nothing to show for that early start. Now meet an older boomer father, 65, who did the unglamorous thing instead. He bought a boring index fund at 40 and never once touched it. He reinvested every single dividend automatically and forgot the password on purpose. 25 years of pure silence turned his modest savings into over $700,000. The young man had all the time in the world and wasted it. The older man deeply respected time and was richly rewarded by it. The single most powerful move in investing is the one that feels like doing nothing. Reinvest everything, add automatically, and flatly refuse to interrupt the machine. A dividend spent is a soldier sent home before the battle is even won. A dividend reinvested is a soldier who quietly recruits two more. Buffett has never taken a big salary or cashed out his snowball. He let every single gain stay in the game for over 60 years. That is not deprivation, and it never was. That is exactly how a good investor becomes an unstoppable one. There is one more trap that catches even careful people, and it is fear of investing at all. Some people are so terrified of losing money that they never invest a single dollar. They leave everything sitting in a savings account earning almost nothing. A friendly bank teller once told Maya her money was perfectly safe there. And technically it was safe, in the way a parked car is safe. It was safe, and it was also going absolutely nowhere. Here is the quiet danger that almost nobody ever warns you about. Inflation shrinks the real value of cash by about 3% every year. Leave $100,000 in cash for 20 years. Its real buying power can quietly fall by nearly half. So doing nothing is not actually safe at all. Doing nothing is a slow, guaranteed loss, dressed up as caution. Buffett's Rule 1 does not mean hide from the market forever. It means take intelligent risk while protecting yourself from total ruin. Maya understood that crucial difference perfectly. She kept a small emergency cushion in cash for real emergencies only. But the rest of her money went to work for decades. Playing it far too safe is its own quiet way of losing. The real trick is to be brave and careful at the very same time. Let me make all of this painfully concrete, so there is zero confusion. Here is the entire plan written on a single index card. Step 1. Spend less than you earn and automate the gap. Step 2. Buy a low-cost index fund every single month without fail. Step 3. Never sell during a crash and never chase a hot tip. Step 4. Reinvest everything and wait far longer than feels natural. That is genuinely it. That is the whole strategy Buffett would hand a beginner today. There is no secret step 5 hiding behind a paywall. The magic was never once in the complexity of it. The magic was always in the boring consistency held across decades. Anyone reading this can start following those 4 steps this very week. The only real thing standing between you and Carla is patience. So let us put the 3 rules back together, because they only work as a set. Rule 1, never lose money, is the rule that keeps you alive. Rule 2, only buy what you understand, is the rule that keeps you calm. Rule 3, let time compound, is the rule that makes you rich. Break any one of them, and the other 2 cannot save you. Diana had the highest salary and the most knowledge, and she broke all 3. She lost money on things she never understood, then panicked and sold before time could work. Carla and Maya were not smarter than Diana at all. They were more patient, more humble, and honestly more boring. And boring, it turns out, is the most underrated superpower in all of finance. Now here is the counterintuitive twist, the part almost nobody ever talks about. Warren Buffett was already a good investor at 30 years old. He was already genuinely rich by 50. But he did not become the Warren Buffett, the household name, until much later. He accumulated $84 billion after the age of 50. He accumulated $81 billion of that after the age of 65. Really sit with that number for a moment. The overwhelming majority of the most famous fortune in history was earned at an age when most people are already retired. Morgan Housel put it just about perfectly. Buffett's skill is investing, but his real secret is time. If Buffett had retired at 65, you would have never heard his name at all. There is a hypothetical that honestly haunts me. Say Buffett started with a normal person's $25,000 at age 30. Say he earned his same incredible returns but stopped at 60. He would be worth about $12 million today. Wealthy, yes, without question. But not a global legend. Not a name your grandmother would know. The difference between 12 million and 150 billion is not skill. The difference is simply decades of uninterrupted time. The extra decades are where the real magic lived the entire time. Here is the one quotable line to carry with you forever. Buffett did not get rich by being brilliant for a moment. He got rich by being consistent for an entire lifetime. You do not need his brain to copy this. You only need his patience. And patience, unlike raw genius, is a choice you can make starting today. So what does all of this actually mean for you specifically? You are probably not going to find the next Coca-Cola stock. Neither did most of Buffett's own returns truly depend on that. The three rules were never really about picking perfectly. They were about not ruining a decent plan with impatience and ego. Protect your downside so a single bad year cannot end your story. Buy only what you understand so fear can never shake you out. Then leave it alone for longer than feels comfortable, and let time turn small into enormous. The next time someone shows you a hot tip with a green chart and a 10 times promise, ask them one simple question. Would you be comfortable holding this for 10 years if the market closed tomorrow? Watch how fast the excitement drains right out of their face. That single question is the whole difference between Carla and Diana. If this showed you something about your money you had never seen before, subscribe to Wealth POV and hit the notification bell. We break down the hidden math behind the financial decisions you face every day. Because the goal was never to be the smartest person in the room. The goal is to still be in the room in 30 years, quietly compounding, while everyone else got bored and walked away.